This episode is brought to you by the Chronicle Protocol, a cost-efficient, transparent, and decentralized oracle. Chronicle has developed a next-generation oracle primitive called Scribe, which reduces oracle gas fees on L1s and L2s by over 60%. You'll hear more about Chronicle later in the show. All right, everyone, I want to introduce you to Bumper, a new DeFi protocol that is here to redefine how you protect your crypto assets. Obviously, market volatility can be a big concern for us crypto holders. Go check out Bumper. It's bumper.fi. Take a step towards smarter crypto asset risk management. Santi, happy Friday. What's up, man?
Oh, not much, I think you somehow this conference virus was streamed through the internets and reached over because I'm feeling some throat pain. And
Blockworks is hurting right now.
I mean,
we're down bad.
I hate to say this, but if there's a way to short Blockworks, the productivity is
you can't say that on the pod. Come on.
I love you guys, but if productivity's down, if more than 80% of the company's down,
productivity's booming. We're ripping. Yeah, we're just doing it with less people right now. We're between the bronchitis, the laryngitis, and whatever this.
Yeah, whatever it is. There has been a spike in COVID. It's like no surprise. Everyone's like, the kids are back in school. But yeah, it's what that dynamic where like you're more productive when you're like very busy or just like you lose. So anyways, maybe it's that.
We're almost 2 years into this bear market from like market tops. How are you feeling about things right now?
It's very interesting to say that because that's the thing that I was mostly focused on, just kind of reading the room, absorbing the sentiment at permissionless. How am I feeling? Probably as important as how like I think the market is feeling. But I do think we're entering this state of just apathy, kind of despair, desperation because
you think we're just entering it?
Well, not entering it. I mean, look, we've been chopping around this range for a long time. I do sense some eeriness in traditional markets. If you're looking, I mean, this week's been terrible for general tech and just the stock market. Like I've said it in prior podcasts, it was not on my bingo card to have a super strong year-to-date recovery of the NASDAQ, of the S&P. It's just been pretty impressive. I don't think it's been substantiated by fundamentals. I'm just really cautious. Largely informed by people that I respect, like Stan Druckenmiller and others that have just generally have been very honest about and open about saying it's been a very challenging environment. And then you go to a conference like Permissionless and you talk to, some of the folks that I was on the panel or just some of traditional builders or particularly allocators like in crypto. And they're like, look, business as usual. There's a lot of very interesting stuff happening in crypto. It's a secular trend. Like, there's reasons to be really excited about all this stuff. But a part of me can't overlook this idea that like anyone that's sub 35 years old has never invested through a persistently high interest rate environment. And I think it has been my kind of thinking for a while that most people are of the mind that we're going to go back to a lower interest rate environment. And I get it. There probably is, whatever probability you're ascribing to, rate cuts has been totally demolished over the last 6 months. We keep like pushing the bar. But more importantly, it's just this, I do think that is, regardless of rate cuts in the near term or in the medium term, I think that as an investor class, perhaps the biggest mistake that we could have done, or I could have done, is not factoring in that we're not going to go back to another 10 years of record low interest rates. And how do you go from there? Not so much of where we are in the bear market. It's more of like that reset of like, okay, like, so what asset class? So what do we do? And how do you manage that? Juxtaposed with this idea that I mean, we're here, we talk about crypto. We are very much you and I wouldn't be wasting our time if we didn't believe that this was the best bet that you could make in the next 10 years. I think that probabilistically with high conviction. And there's reason to be really excited. There's reasons to be not as excited. There's a lot of frustration at times. But yeah, I don't know. I mean, this is from my as an
Yeah.
investor that I'd like to get involved. I'd like to talk to founders on the daily. But I am curious, you as a builder, you manage a lot of people, you cover the space. How are you feeling?
We have different proxies, right, of growth of the industry, right? I can actually get pretty insightful metrics into like our analytics product with the on-chain metrics, but as a media company, right, we have podcast downloads, page views, newsletter subscribers, newsletter open rate. But ad revenue, I think, is a pretty interesting indicator of how actually not just we are feeling, but like the industry is feeling. The bottom of a bear market, ad revenue goes to like a low. At the top of a bull market, actually, there's like a little bit of a lag in ad markets, usually 3 to 6 month lag. Um, at the top, ad revenue is like, everybody's trying to acquire new users. And the reason ad revenue falls at the bottom of bear markets is because companies and protocols don't believe that any new users are coming into the industry. So they don't believe that they need to spend money on advertising. And for the first time in about 4 or 5 quarters, we're starting to see that ad revenue pick back up. And what that tells me is that founders, CMOs, CROs, kind of growth leads at protocols and CeFi companies are starting to believe that either there's a new cohort of people coming into the industry, or that maybe they'll be able to raise their next venture fund so they can allocate or they'll be able to raise their next round, maybe because there's like kind of fresh capital coming into the venture space, as we saw with Blockchain Capital's $580 million raise this week. So I think the ad markets are actually a kind of interesting proxy for how folks are feeling, that people don't really know and look at, because who like, I don't know, between us, CoinDesk, like not many people have info on the ad markets. So
Yeah.
I think that might be a number I'd throw out at you.
That's super interesting. I'd like to understand do you look at the composition of that revenue? Like who is actually spending? Is it crypto natives? Is it CeFi companies? Is it like some other random and how does that change at the top of the market, at the bottom of the market? Like, um, is there a meaningful change, or is it always the same suspects that end up spending money, meaning like protocols and app and crypto native apps?
So it's changed over time. It used to be here's kind of the evolution of big ad dollars coming into Blockworks. It used to be the companies going after institutions, largely because that was also Blockworks' brand, right? So if you look at the advertisers, they're anyone trying to pull AUM onto their platform, not through retail, but by reaching institutional customers. So that would be folks who spent money with us to get in front of family offices, hedge funds, sovereigns, pensions, RIAs, financial advisors, folks like that. So those were like the big custodians of the world, right? The big kind of settlement layers so Fireblocks, right? Copper, Ledger, BitGo, Coinbase Custody, Kraken Institutional, people like that, right? Those were kind of the big advertisers. Then we saw a shift in the bull market, which was the big advertisers and the big kind of money spenders were the big exchanges, right? OKX, Coinbase, Kraken, crypto.com, people like that. Those were the kind of big spenders at the top of the bull market. And now the big spenders are, for anyone who's been going to these conferences, you'll see a lot of the protocols, right? There were protocols at ECC, for example, who spent $3 million on site. And the
Are you
reason
serious?
for,
At
yeah, whether,
ECC, which is an
whether or not that's a
Ethereum.
good use of money, I don't know. But
How much? Oh,
but
wait, hold on. How much? 3 million
I did hear one protocol spent $4 million at
to
ECC. Yeah.
what? To do what?
Side events, basically side events. So here's what everyone needs in a bear. So
Oh,
in
hold on, wait. I'm just really shocked. Maybe I don't know I mean, I know that the conferences can be lucrative. I'm just thinking. I'm just thinking of the guy that massive thread of of FTX and how Sam's parents, his dad was like, "You're only paying me," and like demanded a raise for
yeah.
1 million bucks per year. Like just disgusting stuff. But
So
of course, we know
here's
that they
the here
charter
here
private planes to get Amazon into the Bahamas. But man, like
Here's how ad markets work. At the beginning of a bull market, the biggest advertisers and the biggest kind of cohort of people that companies want to go after are institutions, because oftentimes institutions kind of maybe kick off a new market, or there's this narrative, or like Paul Tudor, remembered May of 2020 or whenever that was, Paul Tudor Jones, Bitcoin's the fastest horse in the race. So then everyone wants to come after these institutions. They want to pull the institutional money onto the platform. All right, institutions come into the industry. market goes up, then who comes into an industry? Retail and consumers, right? So then the big spenders are like in the last bull market, it was exchanges because they were like BlockFi or Celsius or FTX or Coinbase or Crypto.com or whoever, Gemini. They want to get all the millions of users who are coming into the industry onto their platform, because once you onboard onto Gemini, you're not leaving Gemini, right? It's like onboarding onto Bank of America. You're not then going to change onto Wells Fargo. It's super sticky. Then that happens, and that maybe takes another 18 months. Then we go into a bear market, and the number one advertiser in a bear market.
Before we go there, who's measuring the return on ad spend? Okay, first of all, my working assumption is that retail usually comes first. Like retail, all of the crypto cycles have very much been retail led. Stimulus money and whatnot, but it's very much a retail phenomenon. When you talk about institutions, you're say you're a chief marketing officer at like protocol flavor competitor to ETH that wants to spend a ton of money and just raise $200 million. And you're saying you maybe come from Google and you're a marketing guru. What kind of like marketing return on ad spend ROAS are you doing to justify spending millions of dollars? To what end? To convince Paul Tudor Jones to put money on Bitcoin? That guy is
not to convince him to put money into it. Yeah, no, I mean that's right.
Seriously, I'm not like
that's right. So like, here's the metric that we track for folks who advertise with Blockworks: MQLs. So in a B2B SaaS, in B2B SaaS, there are different metrics that matter. So MQLs are marketing qualified leads. Those are the people at the top of the funnel. That is typically like a CMO of a SaaS company, crypto or not crypto, will have one metric that matters. It's MQLs, marketing qualified leads. How many leads are they able to pass to the sales team? Once you pass an MQL over to the sales team, a sales team will have an intro call with them. If they are a qualified lead, that becomes an SQL, sales qualified lead. And then that's when the pipeline starts, and you move it through the pipeline, right? Discovery conversation, that goes poorly, move them out of the pipeline. That goes well, moving through the pipeline. Then it goes to proposal presented, then contract out, and then or intent to buy, and then contract out. So what we help with is the MQL, is the marketing qualified lead, right? So if you are the CMO of BitGo, you're like, hey, I have a 30-person sales team. I've got to feed them leads. We need to reach hedge funds interested in staking. You can't run an Instagram ad. That's fair. Right?
Or like research, or I understand like
webinars, Anchorage, things like that.
If you're a custodian, you want to capture that business. I get it.
And then they have their LTVs, right? Like they know the lifetime value of a customer. If Anchorage signs up, Santiago, or like, when you were I don't know what custodians you guys use when you're at Verify, but like they onboard you, right? They're clipping a tiny percent of AUM, though that actually the custodian model is changing to a SaaS model from a fee model. Yeah. And then they upsell you, right? They upsell you through trading fees and lending and borrowing and all that kind of stuff. So
yeah, no, that I understand that segment of the market. And that was my original question. Like I can appreciate how someone like BitGo, someone like Anchorage, like CFI, you remember that term, CDFI?
Yeah.
Those kind of players, like exchanges, sure. But I do see, and correct me here if I'm wrong, a lot of spend from, like protocols, like, like, I don't know, L1 of sorts. And I think I'd be really curious to understand, because one sector that I've been investing in and thinking about is how do you stitch together a profile to understand, basically like an AdWords, if you will, like just understanding like and stitching together, like to figure out customer acquisition and what type of marketing is effective if you're a protocol, and how do you acquire the said users, because they come from Web 2 and then they enter Web 3, and then there is a disconnect there to some extent. There's a few kind of like companies that I've been looking at that are trying to kind of stitch together this profile of a customer. But I think it's fascinating. Like, and to be fair, I'm not like dismissive of the category. Like, at the end of the day,
no, I know what you're saying.
There's a lot of flow. There's, you can look at it and slice in many different ways. Like the average crypto user NFT, like is above, like, is fairly well off and has more disposable income, and it's a very attractive cohort.
Let me show you. Yeah, let me show you this, Santi. So like, let's talk about the ROI of a protocol doing marketing. So Let me pull up the base. All right, so this is Blockworks' analytics platform. So you can click on base and you can look at the financials, right? So you can see that base, right? You can see the fees. So every day, like here's the fees, 200K in fees. The cost to settle back to the L1 is, on September 14th, they did 189,000 in fees. The cost to settle back to the L1 was 88,000. So the profit was 101,000. Now, what is driving most of this, right? What is driving this black line is profit right here. What is driving this? Well, it's friend tech. So then my question, like the question becomes, all right, well, what is the LTV of like friend tech? Like, let's say you're base. Now, base didn't have to really do marketing, but let's say you're ZK Sync or Scroll or Arbitrum or Optimism. Like, what is the value of getting the two founders of friend tech to build on your platform?
Oh, yeah.
And that was probably a relationship driven deal, but like, at ECC, there's like, or at Permissionless, there's a lot of founders who are like, look, I just came in from Facebook. I'm trying to figure out which L1 or L2 I should build on. And if you're Arbitrum and you've got the 40x40 booth and you are sponsoring the hackathon, like it is more likely that a founder will build on you.
Yeah.
So
no, that's a really good point, actually. There is this idea of like, I always think when you say that VHS Betamax, like sometimes the best tech doesn't win. It's like the best marketer. In this case, VHS was a inferior product, but just had better marketing, had better visibility, had better presence. So ultimately became the standard, and I think that decision tree from founders, I think, is very much real, and I experience it. Obviously I'm biased because I'm an investor in something like Scroll and Arbitrum, but when people ask me, I naturally direct them to, hey, go talk to these teams, right?
yeah.
So yeah.
There is let me read you this quote. So there was just a huge study done on basically B2B buyers and
In crypto?
no, in
generally?
SaaS.
Oh,
in SaaS actually. But I think it applies, I think B2B like I think they're very similar. 2/3 of the time, this was one of the biggest brand studies ever done on buying behavior of B2B buyers. 2/3 of the time, so 66% of the time, when a business decision maker purchases software, they already have a brand in time. And 94% of the time, if they do have a brand in mind, the buyer ends up sticking with that brand.
Yeah.
So like, I don't know. It's funny because like part of my job is convincing marketers that they should still spend on brand marketing in a bear market. Very hard. And I totally get why they don't do that. But like, if you're not part of the original consideration set, there's no way you're getting bought. There's no way they're using you. So
this is very real. Like, actually, this was something that I talked to a few folks in crypto at the conference around.
Yeah,
there are very opinionated folks that just come to the table and they don't do proper like RFPs. They just kind of go with someone because they're just
that's how buying.
And you can't really justify. And it was like, all right, okay, well, did you consider X and Y? They're like, no, we just kind of wanted to do this. And I was like, okay.
It's trust, man. It's
Yeah,
it comes down to trust. So if you do
especially in a bear market, right?
66% times 94, so that is 62% of all software buying decisions are being made with a brand that the buyer already knows. Right. Wow. So that's why something like, so we did this, we sent out this survey after Permissionless.
Yeah.
This is just turning into an ad for Blockworks marketing, but like we sent
we'll
out this,
never do that here.
We would never do that. never do that. We sent out a survey after the conference and got a couple hundred people to respond to it. And one of the questions was like, what's the most memorable brand in your mind after Permissionless? And no surprise,
front and center.
It's the ones who spent a lot of money.
Let me guess, Kraken or Scroll?
It was OKX. OKX was first.
Oh yeah, because they had that. Kraken had like a Formula 1
Kraken was second. I think MetaMask was third.
They had a good booth.
And I think Scroll was like fifth or sixth. I'm pretty sure.
Which were, by all intents and purposes, the largest booths.
So you better believe, like, let's say there's I don't know. Let's say someone wants to get off of, I don't know. I'm trying to toe a line here because they all compete with each other. But like, yeah, people are more likely to now use OKX who went to Permissionless. So
yeah. The brain works in mysterious ways. You get a sticker from a company that you put. By the way, never put crypto stickers on your tech gear for an OPSEC perspective, folks.
I know.
Stay safe. nonetheless, some of those are really cool. Like you want to put them on, but I've
Skull
seen
has good
laptops. I've seen
stickers.
laptops like with bombard. I'm like, guys, you're at a
Yeah,
cafe and you have every single crypto logo on your laptop. You best believe someone's looking at that, and you're a
best
target.
believe
So you know,
you're a
just
target.
please. But like there's some good merch.
I have a markets question right now, like kind of
Okay.
shifting gears a little bit.
Sure.
So
Sorry, guys, this
you,
is not a marketing podcast, but hey, it was interesting. It's just shocking, but
well, you didn't join us on this podcast, but Antonio from Spindle came on,
right.
and Antonio helped build the ad market team at Facebook, and so you should go listen to that
Mhm.
podcast. All right, so there's a liquid trade that's happening right now.
Uh-huh. Yeah, it's been
Mainly
going on for
into
a while.
It's been going on for a while. So I said Lido in the Telegram channel, but really it's Maker. So I just had breakfast with that fund I was telling you about that is going to announce soon, and then Coin Fund. Coin Fund was there too, and there were some other like kind of big crypto investors there, and everyone's talking about like what they call the most crowded trade in crypto right now, which is Maker. And if you look back over history, the last at least 5, 6, 7 years in crypto, kind of sustained positive repricing of a couple of altcoins oftentimes leads to this kind of market wide rally because people get excited, they start chasing
Sure.
other things. And if you look at the beginning of this year, or maybe it was end of last year, but Lido and Sol led the way. And it was probably actually beginning of this year, like January, February. Lido and Sol led the way. And then a kind of bigger market wide rally came. Now it sold off, obviously, but that's all right. So right now what's happening is people are flooding into this kind of crowded Maker trade pretty quickly. And Maker's up like 30, 40%.
Yeah, it's
Um,
outperformed.
in the last couple of, I don't know, month or two. I haven't looked exactly at the charts, but and I think a lot of that is because people are getting excited about Rune and really the sub DAO vision and stuff like that. I would just be curious how when you see something like Maker outperforming, right? How do you start to think about, hey, is that trade over yet? Should I kind of pile into that? Do you say, hey, look, I'm not going to pile into that trade, but maybe this is a harbinger of this kind of coming market wide rally, I should start to allocate elsewhere? Or you're like, look, I'm not touching trading. I'm staying away from this game.
Well, I think everyone in crypto needs to somehow is forced into this liquid venture conundrum, which is you cannot overlook trading from a risk management perspective. Even if you were a longtime believer in Maker, you constantly need to wake up and do this exercise of, based on where things are today at a particular price valuation, would I from scratch build this portfolio again in the same weight and in the same composition? And that's an exercise that probably some of the best advice I've gotten, and a framework that I take to heart. You wake up each day, not each day, on a some sort of cadence. To your point, so yeah, like I pay attention to trading, because if a position becomes a disproportionate share of my portfolio, like it's a problem. I need to manage that risk somehow. And so, but I don't like chasing these narratives. Like, I do think that there is a probably half of the folks that are, or more than half of the folks are piling onto this particular trade, as they're the same kind of folks that pile onto these trades. Maker, for instance, it was very obvious on chain that the largest holders of MKR, A16Z, and Paradigm were dumping it. They were sending it to an exchange. Usually people send coins to exchanges to, dispose of them. And they were pretty big holders, and they've been for years. I think A16Z led some of the earlier rounds. And so as MKR started to rally, they started selling off. I think and by the way, what's so interesting about crypto is like you can understand the wallets if you're using an analytics tool or whatnot. A lot of these wallets, and then you're seeing exactly how the position that they have, right? Unlike like 13Fs, right, where you see the retroactively what hedge funds did in that quarter. In crypto is real time. Like you say, okay, they have 10% of the supply, and every day they're selling at X amount, which is X% of volume. And so you're seeing a seller in real time. And so that was part of what sometimes catalyzes these trades, right? And or like large unlocks and whatnot. For Maker also, I mean, we had Rune talk about the end game. It's a protocol that is, you know, from a fundamental perspective, I mean, I don't have the figures in front of me, but it spits out cash flow. You know,
I think they'll do 100 million in revenue this year. Don't
right.
quote me on that, but I'm pretty sure.
Give or
Yeah.
take, right? And so if you look at what are the kind of the valuation of Maker, the market cap, what is it now? You probably have it in front of you, but I'm gonna just pull
What
it
of
up.
Maker? So Maker's up 115% in the last year.
No,
The
no, I
market
understand
cap,
that, but I'm just thinking
the
about like
market
from
cap is
a
like 1.3,
one
I
point
think.
two billion, fully diluted 1.3, right? And so if it's cranking out 100 million of revenue, you know, you could argue that it has some of the, it's what 13x.
13x. Yeah.
I'm sorry to break it, folks, but you look of any tech name. First of all, it is very interesting that you have like cash flow generative companies this early on in an asset class that is very much super early stage. Like, go look at like Instacart, they just IPO'd, Uber, Amazon. I mean, these businesses are not cash flow generative. They don't have positive unit economics. But they've only survived because over the last 10 years, I go back to this, we had free money. They wouldn't have worked otherwise. And that's
I have a theory on those businesses.
like
All
no,
three of
no.
the ones you mentioned, by
I
the
mean,
way.
like
But
fundamentally, this is like, no surprise. We've had Ben Foreman here, my former partner at Paradigm. He's a maker bull, has been as maker of as much as a maker bull as one can be
yeah, yeah.
consistently.
Well, you guys jumped in on whatever we call that day, Black Thursday, right?
Oh God. Yeah, that was fun. And we were very active talking to the team. And it's one of those things where how long are you willing to be patient? And this is a common problem that you have in particular in crypto or just liquid markets where like MKR just grossly underperformed ETH and everything else for a really long time. And so did DeFi. DeFi started really underperforming ETH even before, there's semblance of rate hikes and everything else, tumbled in November of 2021, 22, 22. And so it's really difficult when something like that in your face is just, underperforming. What do you do? Do you pile on? Do you buy more? You have your, you know, really eats at you. And so, I mean, is it a crowded trade? You could argue that at 13 times PE. The real question is, where does that go? Like, where's those earnings go given the fundamental changes in the protocol and the end game and what in Rune is articulated? That's what I care about. Um, why would Maker's business model is effectively allowing people to programmatically mint a stable coin, a stable unit of account called DAI, um, depositing a particular asset, said ETH, for instance, ETH. And that was really the novelty of Maker in a very volatile asset class. You want to borrow against your holdings, particularly in a bear market. Like Maker really got a lot of traction in the last bear market. That you could have looked at Maker, and that's where people really started to say, huh, you have an asset class, particularly ETH, that has gone down 80%. And this protocol has allowed people to borrow against that don't want to sell because they didn't sell at the top, to borrow and has maintained solvent in very adversarial conditions. Like this is pretty interesting. Like, in traditional markets, something goes down 10%, the regulators step in and freeze the goddamn trading, banks collapse. And so that's when actually that's the real story behind DeFi taking off. Not to like do, history here, lesson 101. But to your point around, yeah, I do think that is it a crowded trade? Probably hard to tell.
Hmm.
But if you look at the fundamentals, you say, does it have more room to grow? Well, you'll be the judge of that if 13 times, if you believe in the quality of those earnings, if you believe in, macro does, there's high correlation, yada, yada, yada. But more importantly, I think it's the idea of, and we keep talking about use cases, that is a killer use case. Like the idea of borrowing against and like the money market use case is very real. The DeFi use case is very real. Um, and then you do a market analysis. How many more people do you think are going to show up to mint to borrow against their holdings? And are they going to be the preferred venue to borrow against those holdings? Do you believe in DAI? Do you believe in their, multi-collateral DAI, which is a huge controversy in this end game. So anyways, long story short, I don't pay much attention into these things, but it is an interesting opportunity if you, for instance, have been doing your homework on some assets, whatever it is, Maker. I always have a shopping list. I have literally, I track 20 names or so, and add, cut to the list. And then I'm looking for catalysts. And the best catalyst that I love is a force seller.
Yeah.
Like, you see someone that's just force selling? Yeah,
Yeah.
fine. I'll clip. I'll buy.
When you have a shopping list, do you put a price next to it?
Yeah, I have alerts.
Okay. And when you see that price, all right. So let me just use Maker. I'm not saying Maker's on your list,
Sure,
but right
yeah.
now Maker's trading at $1,300. Let's say you had a price. Let's say all right, Maker goes on the list. Then you're like, all right, well, what price am I a buyer of Maker? Maybe you say $1,000.
There is a
So then
price of ETH where I will literally sell traditional assets, load up the
I will
truck.
sell my podcast equipment. I will back up the
Basically,
dump
yeah,
truck.
I'll go to a pawn shop
Yeah.
or even raise a fund.
What is that price of ETH for you?
Sub 1,000.
Sub 1,000.
None
Back
of this
up the
is
dump truck.
financial or investment, folks. This is just my opinion.
Yeah, people know that.
And I a lot of the conversation, not to but a lot of the conversations I had with folks way back was like, if ETH hit 900 or so. Largely, it's informed by the prior cycle low, and also I think we've been holding and hovering around this $1 trillion aggregate market cap, which is, anyways, I triangulate to it. But I think ETH at sub 1,000 is something that I am quite interested in.
Yeah.
Solana.
You think we get there, this market?
Man, this is
Try it.
Every single time.
Take a shot.
Look, I will say this. Every single time that I think I'm not going to see an asset at a given price ever again. Those memes like, folks, this is the last time you're going to see Bitcoin at 30,000 or 10,000. Yeah. I'm like, you could almost counter trade that to a T and be patient. So I'd be fooling myself if I were not paying attention to traditional markets. Something that I've been paying more attention to. I appreciate it. It's not my strength. It's super hard, but you have to pay attention to it. Like, it feels fragile. And I do wonder, again, the biggest question is, if we're in a persistently high interest rate environment, what's the appetite? Where's the incremental user going to come from? At this point, to me, it feels like we're sloshing around funds within crypto, and there's just a value transfer from one player that's already in the economy to another. I don't see many people coming in.
Yeah.
But, perhaps the question to you, which from your vantage point, how are you feeling about, do you think we'll ever get, a Sol sub 10, Bitcoin back at 10K, or 15K, not to exactly say, is it going to be 15, is it going to be 16, is it going to be 20, but what are the things that you're seeing that you would, that from a probability standpoint, do you think it's a higher or lower probability we see, for instance, with ETH? Do you think there's a higher probability of seeing ETH at 2,000 or back at 1,000? Sorry,
2,000.
ETH at 2,000 or back at 1,000?
2,000, hands
2,000.
down. Hands down.
Okay. All right.
The reason for that is because to get to what's ETH at today? 1,500?
1,590. Call it 1,600.
50%. Okay, so the reason for that is because the only way it gets down to 1,000, in my opinion, is if there's something catastrophic that happens in crypto. So you could have a big macro drawdown, for example. Macro drawdown would pull it down to, I don't know, 1,400, 1,300, something like that. Things that pull prices down that strongly are FTX collapsing, Terra collapsing, Celsius and BlockFi going under. Big, colossal crypto inside the ecosystem movements that suck all the liquidity out and cause a bunch of forced sellers. That, I think, is gone in crypto. I don't think we have another.
A lot of people believe that. We've washed out a lot.
I think we've washed out all of
from states, but
all of that. Now, macro could get much worse before it gets better. The the Nasdaq could go back down after having a decent start to the year, and that would push, because crypto's farther out on the risk spectrum. That would push it down, but I don't think you see.
And
I
just to
don't
put it
think
in
you'd see that.
perspective, just to put a finer comb on this, so it's like this would be a 25 to get to 2,000. Basically a 25% rally. To go down to 1,000, it's like a 37% drop. So there's
Right.
a bit more. There's a bit more. But
So
again, the Nasdaq's up. What is it? 27% on the year. If if crypto has a 3x, 2 to 3 times beta, do you believe that the Nasdaq can't drop 10%, 12%, give up some of the gains?
is the beta that strong to the Nasdaq?
On the downside, I would
Hmm.
think it's definitely. I think it's 2-ish. I mean, it's always depends on what kind of timeline you use, but it's fairly high.
Hmm.
I hear your point, though. I hear your point. The other issue, though, that is we ought to
Oh wait,
have.
I have one more
Well,
question on this
I was
one.
just gonna say
Oh
one
yeah.
thing. The thing that we ought to have is some of the. You remember Jania? Some of these traders, right? Because liquidity is very thin in crypto.
It's thinner. It's thinner now that the market
It's
makers are all fighting on Twitter.
very
Are you
thin.
you
So
watching these these
so
fights?
we're back to we basically are back to early days, very limited crypto trading infrastructure and liquidity, and so it takes these price movements can happen, particularly in the absence of robust liquidity. But anyways, I interrupted. You were saying.
Well, we actually have the infrastructure, unlike last time. We just now don't have the liquidity again. But
Yeah,
so
true.
okay, so Maker. So let's say you add Maker to the list. This is how this conversation
Mhm.
started. So you have Maker on the list. It's at 1,300 today. Let's say you have a price target at 1,000. Let's say Maker hits 1,000. Do you buy? And let's say you have or $100 to allocate. Do you buy? Do you allocate all 100? Do you go
Like
20
cost average your
bucks
way in.
for 5 weeks? And
Depends on the magnitude of the drop. Some days you pull the stash fund and you buy the full amount. You get filled. But largely I would probably reserve still some amount. It just depends on the magnitude of the drop. For me, I always feel comfortable when there is a very big shakeout, I feel comfortable adding in a meaningful way. Historically, I think that's been served me well, but at times, yeah, you May of 2020, that infamous day, ETH went ETH dropped quite a bit, and then it rallied a bit, and then it just it continued to go down. So you said it before the podcast. You want to catch a falling knife? I don't know. It's impossible, right? But I just feel comfortable adding and lowering my cost basis. So I in this environment, I would want to hold some cash. I think it's different from an institution. Like if you're a fund, most of the time they're allocated. They want to be fully allocated,
yeah.
and holding cash is not something that you kind of do, right? But yeah, it is also a matter of what percentage of the portfolios is, and what percentage of the portfolio do I want it to be pre and post.
All right, everyone, I want to introduce you to Bumper, a new DeFi protocol that is here to redefine how you protect your crypto assets. Obviously, market volatility can be a big concern for us crypto holders. Bumper alleviates this by allowing you, the user, to lock your tokens into the protocol and set a price. No matter how much the market fluctuates, your investment in your token won't fall below the predetermined value. When you compare this to traditional options platforms, Bumper offers a non-custodial and actually cheaper on average alternative that protects the value of your crypto from market price drops. If you are looking to earn a yield on your crypto, Bumper has you covered. By depositing USDC into the Bumper protocol, you can earn a return which is derived from the premiums paid by protection buyers. Early adopters and Empire listeners have a chance to claim a part of the $250,000 early adopter bump rewards. Go check out Bumper. It's bumper.fi. Take a step towards smarter crypto asset risk management. This episode is brought to you by Chronicle Protocol, the best on-chain source for cost-efficient, verifiable data. For anyone who listens to Empire a lot, you know that we talk a lot about MakerDAO. Well, Chronicle Protocol is this novel Oracle solution that has exclusively secured over 10 billion in assets for Maker and its ecosystem since 2017. And for the first time ever, super excited to share here that Chronicle's Oracle service is now publicly available for anyone to use. Compared to using other Oracle services, Chronicle offers a 60% reduction in gas fees. They have an unparalleled level of transparency at Chronicle. They offer a dashboard that allows anyone to track the genesis and trajectory of the data it provides, marking this milestone in on-chain data availability. Chronicle is endorsed by a network of the most revered validators, including Etherscan, Infura, Gitcoin, DYDX, and MakerDAO. It is time for a paradigm shift in Oracle development, a future where data is verifiable, operational costs are contained, and the possibilities are immense. You can learn more about Chronicle at chroniclelabs.org. That is chroniclelabs.org. You want to run through some of the news this week?
Sure. Yeah.
Cool.
Let's do it.
Cool. We can go quickly through these.
Yeah.
Maybe like one takeaway from each story. So first story was blockchain cap. Raised 580 million.
Pretty impressive.
Yeah, very impressive. So blockchain capital, for those who don't know, is the largest running crypto fund, I think. Correct me if I'm wrong. One of the longest. It's been around for at least 10 years.
One of the longest, not the largest.
I think actually 10 years. 2013, not the largest, but the longest.
Yes.
Bart and Brad, and I think Brock Pierce was one of the third founders as well, but it's really Bart and Brad Stevens. They raised so 580 million. It goes into two funds. There's the Fund 6, which is their early stage fund, and then what they're calling an opportunity fund, which is the later stage. Some major institutional investors, a couple of big names that were announced, Visa and PayPal. Crypto venture right now is at an all-time low. It was a 3-year low. So lowest it's been since 2020 in terms of like capital that's flowing into crypto venture. So this is a huge raise, I would say. Curious if you think the VC climate is changing. My understanding of like a little bit of the behind the scenes of this blockchain cap deal is that it was already it's been, maybe this was the second close or
that would actually be great to know, because I spoke with his fund of funds and I mentioned the prior pod and they were like, there's zero interest. So I got to think a lot of the fundraising in funds, not just in crypto, is, as you said, a couple closes, first close, second close, third close. So I had probably been in the market for a long time. Maybe their target was $1 billion and they raised 500. But these are, I mean, I would love to maybe have the guys on and give us a little bit of inside take on how the process went. And, a lot of, maybe it was, how much of that was existing LPs recycling capital? How much of that was new LPs? Was those family offices, endowments? Where they come from?
Yeah. Comment on the YouTube video or tweet at us if you want us to bring on blockchain cap on the pod, if that'd be interesting.
Yeah.
One other interesting note, and then we can move on from this news, is the late stage investing, kind of the Series C, Series D. So 600 million is a huge, or 580, a huge amount of capital. The late stage has been dominated by a couple of small, a couple of very specific firms like 10T, who invested in Blockworks. They've kind of dominated some of the later stage stuff, right? Because they can allocate like 100 million, 200 million into a company later stage, right? Kraken, Gemini, Ledger, some of these really large influential brands where they're raising 500 million. The lead has to put in like 200, right? Or 150. And so interesting to see more folks get into that later stage.
Yeah.
It's a tough space to play in because you need so much capital. So, all right, next up, PayPal. So PayPal released pyUSD, which is the PayPal stablecoin. They announced that it is going to be available on Venmo. So PayPal owns Venmo. I think they bought them for pretty cheap, like 26 million several years ago. They announced that the PayPal stablecoin is going to be available on Venmo. Inside of the PayPal ecosystem, there'll be no gas, or they cover the gas, but user won't see the gas outside of the PayPal network. So, right, if you have the stablecoin on Venmo, you want to send it to a friend on Venmo, no gas. If you want to send it outside, let's say you want to send pyUSD from Venmo to your wallet and put it into Aave or something like that, then gas will apply. So
yeah, that's huge.
I think I do think PayPal is kind of like this big behemoth of a financial services company. Obviously, it's cool to see. I've always thought one of the problems with payments is that there's no interoperability between these brands, right? I'd like Cash App and Venmo.
Yeah.
Why can't I move my money between my Cash App and my Venmo? They don't talk to each other. So this is a cool development to be able to, if I could send money from Venmo into Cash App, into Robinhood, into my TD Ameritrade account, like there right now you have to send it almost back into your bank account. Not almost, you have to send it back into your
Yeah.
bank account. It's cool if these things all talk to each other.
I mean, Plaid in some capacity, but
You don't send it to a Plaid though. Plaid is the connective
no,
tissue.
that's my point. Yeah.
Oh yeah, yeah.
That's a connective
So
tissue. Yeah, well,
it'll
Plaid
be
ended up
the
being valued at like a couple $1 billion. I'm like, guys, you don't need Plaid in DeFi. Everything is
yeah,
composability is a beautiful thing.
yeah. Plaid guys, Emory alum, good people.
Yeah,
Um, the number to look at is the demand for pyUSD. Right
yes,
now it's a whopping 44 million. So not much demand, I would say. But we will see as we'll pay attention to this number as it goes on Venmo.
for sure.
Yeah. Um, other news of the week. What do you got for me?
Well, there's of course that huge what is it, legal document, dossier, whatever you call it, that came out detailing a lot of juice behind FTX as it prepares to go to court. Detailing a lot of the apparently Sam's parents were heavily
So
involved.
I didn't read this yet.
Oh
Can
god,
you give me the
this is
who,
like soap opera thriller. This is your entertainment piece of the week, folks. I'm waiting for the documentary to come out, like pretty pronto here. But yeah, apparently Sam's parents are very renowned Stanford professors, Barbara and Joseph, I believe. They were involved heavily. Apparently, the big realization was they were very involved in the structuring and the operations, some operations of FTX. The father of Sam, there's some exchange between him and Sam, and he was like demanding a higher a salary raise. He was like being paid
wait,
100.
his dad was demanding a higher salary
I
from
think it
his
was
son?
being paid like 117,000 or like not no like 17,000 a month, and he's like,
Epic.
no, I want $1 million a year and something like that. And
Epic.
so it was like it's pretty interesting to see it. Like, anyways, and then all the donations, and of course Stanford is returning, I think 5 million that was donated from FTX back to the what is it, the trustee or so, the the folks that are handling the bankruptcy. Yeah, so it was very detailed. I mean, it's a great threads out there. There's like it's just shocking, to be honest.
Yeah.
There's one piece of news, as I heard you say, Ledger, that I don't think we covered, but I believe one of the co-founders stepped down. But this was like a couple of weeks ago, September 6th, I believe, is when he announced it. And I think a lot of it was just as a result of the social recovery kind of fiasco, if you will, or just kind of drama.
Oh, that's funny. All right, so I clicked this I clicked this article. The SEO hasn't updated. So the Google, how it shows up in Google is Ledger co-founder bids farewell after recovery fiasco. And I click the link and it says Ledger co-founder departs to pursue project to onboard more users into crypto. So some editorial brand I won't name change their title.
Yeah.
I have actually what I think is probably the biggest news of the week, which is Eclipse. We probably could have
Right.
started this whole
Okay.
podcast with Eclipse. Eclipse announced that it's launching their SVM Ethereum kind of Celestium L2 on mainnet soon. So let me try to explain this. I think actually folks should listen to Mike, other co-founder of Blockworks, went on Bankless and kind of explained how there's these three kind of converging um, ecosystems with Cosmos and Solana and Ethereum, and they're all kind of looking over each other's shoulders, saying, "Hey, look, I like what you're doing. Let me kind of take a piece of that playbook and pull it over here." So one of the problems today is that the kind of single threaded EVM with global fee markets has put ETH L2s at a little bit of a disadvantage to newer alternatives by kind of forcing developers to pursue these app specific EVM chains. You get this isolated block space, but it really severely fragments UX and liquidity, adds a bunch of developer complexity. So Eclipse launched Eclipse's mainnet. Kind of what they say is they leverage the best pieces of the modular stack, right? So what they're doing is they're using ETH, they're using Ethereum for settlement, They're using the Solana VM virtual machine, the SVM for parallel execution. They're using Celestia for data availability, and they're using Risk Zero for ZK fraud proofs. So it's pretty interesting to see this, right? Settlement is on Ethereum, uses ETH as the gas token. Execution is on uses the SVM, which enables right parallelized transaction execution, greater throughput. Data availability is provided by Celestia, offers higher bandwidth than Ethereum's DA. And then the proving is using Risk Zero for ZK proofs. EVM compatibility is done using the Neon EVM, which allows for I think my understanding is really easy deployment of EVM smart contracts on Eclipse. So this is kind of what we're seeing here is like the best pieces of all of the modular stack coming together. Been interesting to see. The takes have been all over the place. I think, right? Some people are saying ETH killer. Some people are saying long Sol. Some people are saying Sol is dead because of this. Some people are saying, look, because of this news, it's clear ETH is eating the world. Solana tech is eating the world. Huge wins for L2s, bad for L2s. Some think this is bullish for Solana. Some people think it's not. I'd be very curious. I can get into more of the details of this news if you want, but would also be curious just to hear your thoughts on this.
I don't. First of all, I don't think it's negative like an ETH killer. It's just why would it be an ETH killer?
I just saw some dumb tweets. I would.
Yeah, I was like, no. Yeah, it's very interesting how
It's obviously. I would say it's obviously not an ETH killer. The mainnet settles to Ethereum, uses ETH
it's the same people
as
that
the
say
gas
the
token.
L2s are like
It just
cannibalistic to
uses
L1s.
the SVM for scalability, right? It's
Right.
basically saying we want to use the SVM for scalability, but we really want to leverage the security and the network effects of Ethereum. So let's do that.
I'm actually really encouraged by this because I think assuming that you don't lose efficiency or the connectivity actually works by pulling and picking and choosing the best kind of parts of the stack to leverage for aggregate execution. I think I mean, it intuitively, and I admittedly haven't looked too deeply into it, it makes a lot of sense.
Yeah.
The real, probably the critics might say, well, um, there's a trade-off by doing that relative to a monolithic structure or I don't know, like, and so I'd be curious, maybe Mike or some other folks can have a more informed opinion on how that execution by doing all kind of this picking and choosing of the best parts of the stack compares to like what would you say, like a monolithic architecture?
That would be I mean,
Would that
yeah,
be
that would
I
be the
mean, I'm sure there's other
comparison.
comparisons you can make,
Yeah.
but like you see what I'm saying? Would compare it against not using kind of the best of all worlds and seeing, how that compares from a fee, from a latency, a secure aggregate security standpoint, whatnot. But you know, I think it's very encouraging.
Yeah. I agree. I agree. I think I think the FUD on Twitter was probably due to everything in crypto has had to either be good for Ethereum or good for Solana or good for something else. And then that inherently means it's bad for
It's
someone
a
else.
it's a
And I
stupid
would
win
argue
lose
this is just
mentality.
good. Yeah, this is good for both parties. I don't know. I think it's really cool. It's the first SVM roll up on Ethereum, right? I'll go back to Mike's conversation, right? He said soon it's going to be possible for an application to be built using the Solana virtual machine, using Celestia for data availability, and settling everything back onto the best security, which is Ethereum. And that's
Yeah.
what you're seeing literally
Yeah.
in real time right now. So
I remember folks have a short memory in crypto, but this was like layer twos and breaking composability was probably the buzzword of DEF CON in Osaka. This was before any L2 launched.
what was composability?
Breaking composability.
Breaking composability.
This was
Okay.
like a thing. This was names of panels. People were talking about it. This is like, it's going to really detract from the value proposition of Ethereum, and DeFi is going to break. This is peak DeFi, right? Or DeFi was really taking off. And look, I'm not technical to understand how the internet developed, but my hunch was that the internet kind of went through this problem too of latency. And I asked the question to someone. It's like, that was like James Prestwich or someone that I think is very smart, and said, didn't the internet kind of go through this? And it's not so much that you're going to break composability is kind of a bad term. It's just you're going to degrade composability. You're going to it's a latency thing. And shouldn't we be focusing on improving latency? Like, or you can never improve it. Like, it's just you break it and that's it. Like, and I always felt in my uneducated mind, technical mind, that we should probably focus more on thinking about ways and use cases that not all use cases require the same level of atomicity and execution. Number one, so you could have different roll-ups, and then you can trade latency for lower costs. You know what I mean? Like if you're playing a game and you don't need to settle that instantaneously. You don't need, if you're using a flash loan for DeFi. Yeah, you're probably going to do that in the L1 because you're probably seeing some crazy arb and you're sloshing around millions to clip some sort of close the gap and profit. And it's an economic decision that is very clear to use the much more expensive highway that you're going to pay for. But you can use the non-highway, non-toll route and pay a lower fee and use L2 because you don't care so much about this like composability. You don't care as much about atomic execution. And a lot of the folks that I talked to back then in Osaka, this was like 5 years ago, like pre-COVID, were of the mind that yeah, we probably should think about that connective tissue between all these different chains. And I think that's what you're seeing unfold now.
Mm,
Like
yeah.
there is a lot of tech. There are so many different use cases. Like gaming requires different security than DeFi, than NFTs, than other potential use cases. Um, and I think over time, the connectivity between chains is going to improve dramatically, and there's going to be a huge opportunity for a relayer, for instance, to in the same way that you can do the instant checkout. Instant when you're on Venmo, I think there's an ability to bring the money back to your bank account, right? And you can do instant, and it charges you 5%. You can wait 2-3 days, and it doesn't charge you. Same thing. Same thing. It's a priority fee model. That's why in the gas, the way we think about gas, which is one of the things that I really like about Solana, is this dynamic gas that really is much more flexible. It's much more interesting and how things actually like it's a market, but
Yeah.
having a flat gas is really difficult when you think about all the different kind of varying use cases. But when you have a dynamic gas model, I think it's much more interesting. But I suspect we're going deep in the rabbit hole. But yeah, a lot to talk about. I think yeah, I think it's a good place to end.
Yeah. Agreed, man. I just Mike's walking into the room, barging
I
in,
also
so he's kicking me
probably
out.
saw Mike kicking you out of the room. So Mike's to blame here, folks.
Mike's to blame.
We could have
Always
just
to blame.
the reason why we're not leaking alphas because Mike just
You
just
can't give that to Mike. Can't give that time. Here, last interesting thing we won't talk about. I'll just leave it in people's heads. Is I feel like you're seeing all these alt L1s that haven't taken off recently go become L2s on Ethereum. Like Canto just did this.
Mhm.
Cello is becoming L2 on Ethereum. Interesting to see
Yeah.
this happen.
Hey, I want to get your thoughts next episode on the Real World Asset Summit. Didn't you go to that one?
Yeah, I did go to that one.
All right. Well, we will spare you 2 episodes in a row because we talked about real world assets on the prior
It
one.
was really good. It was. Do you know that there's a RWA? All right, so there's a company called Figure, which was Mike Cagney's company. Figure said that, hey, look, we can bring our costs of settling loans down by like 80 to 90% if we put it on the blockchain. Uh,
We
okay,
were
now they're
investors at Verify
oh,
and
interesting.
Figure,
Okay, so that was like 5 years ago. They said that. Then they're going
like
public, so they had to
HELOCs and
spin
stuff like
out
this.
HELOCs. Exactly,
Yeah,
exactly. So
dude.
they had to spin out their blockchain. They called it
I've been
Provenance.
around.
You've been around the game. So they spun it out. They will do $30 billion on chain this year. And the flow is basically users get a HELOC
Mhm.
from Figure. Figure puts that on Provenance.
Provenance was the blockchain. Yeah.
Provenance is the blockchain. And they on the other side of that, it's like Apollo and KKR and
Yeah,
BlackRock sitting on
they've
the other
been
side of that.
streamlining costs in the back end,
So
and
I met the
that
CEO of Provenance at RWA. I was like, that's pretty interesting.
this is a beautiful place to end because when people question the use cases and that this tech is not being used, it's not so much that it's not, it's just you haven't heard of it. And that's the state we're on crypto. because you feel that you're getting fed all the information in crypto Twitter. And you feel all very empowered and smart because you're looking at friend tech and you're in the cool tech. But there's a lot of boring stuff happening behind the scenes, like this. And I think it's very encouraging. Like the cost savings are there, the use case is there, and it just makes sense. Like
Good place to
so,
end, sir.
absolutely.
Good
Anyways,
chat.
folks, have a great weekend. And we'll see you here next week.
See you on
always,
Tuesday.
I am being more active on the comments on YouTube. It's like I'm more active on YouTube than I am on
More
Friendtech.
active, more obsessed.
I'm more.
Say.
No. I'm active. I'm actually not on Friendtech, folks. I am active on YouTube. So go drop some comment there. I'll be lurking in the comment section.
Dude, you gotta respond. You gotta respond to these. The reason I don't.
Oh, wait a minute.
The reason I go.
No. I'm gonna interrupt here because I remember, thanks to one of our listeners who posted on YouTube, who reminded me of the bet that we had made of who had the most followers.
No, this is not a real bet.
Listen, hold on. We have our witness Joseph here, who's our fantastic producer in the back end. He does fantastic work. He also confirmed this. Yano said that he would shave his head if he had less users than I did upon permissionless. And that was the case, folks. So one or the other, or he shaves and then he just kind of like comes on bald, which I think might be the reignition of a true bull market. We need that bald energy, like, Brian Armstrong kind of stuff.
We do need that. Bald is back, baby.
Bald is back. Yeah. I'm never going to do it because, first of all, I would never make a bet that I would not win.
Please.
No, I'm kidding. I've lost many bets in my life. But more importantly, we could also live stream it. So if you want us to live stream Yano,
what is this?
Like, it would be kind of nice if you're being shaved, like just like Mike can do it or someone can do it, and then we talk about crypto while we're doing that.
Yeah.
That would like be like I would be willing to do a double or nothing where that might be the most viewed episode of Empire. If we live stream you being like, you're shaved, like being, I think that would be the most viewed episode. And I'm going to go double or nothing on that. Excluding Eric Voorhees, like, permissionless.
We're wrapping. I'm over time.
All right, folks. Okay. Time to cut it out.
Cheers, folks.
See you here next week. Have a great weekend.